A fund returned 29% per year for 13 straight years, one of the greatest track records in investing history. And the average investor inside that fund lost money. That's not a riddle, that's a documented fact. But here's what makes it worse. Some people saw it happening and tried to protect themselves with a different play. They lost too, just in a different way. Right now, there are two groups of people who both think they're being smart with their money, and both of them are walking into the same trap from opposite directions. By the end of this video, you'll know which group you're in, and what to do before it's too late. That fund was the Fidelity Magellan Fund. Peter Lynch ran it from 1977 to 1990. He averaged 29.2% annually for 13 consecutive years. If you'd put in $10,000 at the start and never touched it, you'd have walked away with close to $280,000. But the average investor in that fund didn't make anywhere close to that. Many of them actually lost money. How? Because they couldn't leave it alone. The fund would surge 40% in a year and people would rush in. Then it would dip 15% the next quarter and they'd pull out. It recovered, they jumped back in. It dipped again, they sold again. 13 years of the greatest performance in fund history, and they traded themselves into a loss. And that's not isolated behavior. A research firm called Dalbar has been tracking real investor behavior for over 30 years. Every year, they publish the same study, and the story never seems to change. In 2024, the S&P 500 returned 25%. The average equity investor, 16.5%, an 8.5% gap, all because they moved their money at the wrong times, often right before a major rally. But did I just cherry-pick one year? Unfortunately, no. According to Dalbar's quantitative analysis of investor behavior, the average equity investor earned 7.13% annually over 30 years. The S&P 500 earned 10.65%. But that's only 3.5 points a year. Sounds manageable, right? Wrong. Put $100,000 in the market and leave it alone for 30 years at 10.65%. You earn about $2 million. That same $100,000 at 7.13%, because you moved it around, $800,000. $1.2 million. Not because you picked bad investments, you picked good ones, and then couldn't stop interfering with them. That's Group 1, the tinkerers, the people who can't stop doing something, consistently underperforming the market. Now, you probably already know the lesson here. Don't panic sell, stay invested. Everyone's heard that. But here's the problem. That advice, while correct, is only half the picture, because there's another group of investors doing the exact opposite, and they're losing too. While Group 1 can't stop touching their portfolio, another group looked at theirs and said, "You know what? I'll just step aside." Group 2 made what feels like the responsible choice. They looked at stretched valuations, uncertainty, warning signs, and they moved to cash, high-yield savings, money market fund, maybe some short-term bonds, earning 4 or 5%, sleeping well at night. Let me show you what that decision actually costs. Say you moved $100,000 to a savings account earning 5% in January 2024. By December, you'd have about $105,000. Feels solid. But the S&P 500 returned 25% that year. If you'd stayed invested, you'd have $125,000. You gave up $20,000 in 1 year for the privilege of feeling safe. But that's just the good year. Let's play out the real scenario most cash sitters experience. They're waiting for the crash. The big one. The 30 or 40% drop. Then they'll jump back in at the bottom. Sounds brilliant on paper. In practice, it almost never works, because nobody rings a bell at the bottom. What actually happens is the market drops 20% and you think, it's going lower. It drops another 10% and you think, see, I was right to wait, and you wait some more. Then it rebounds 15% in 2 weeks and you think, that's a dead cat bounce, it'll come back down. Then it climbs another 20% and you realize you missed it. But now it feels too expensive to buy back in, so you keep waiting. This isn't hypothetical, it happens every cycle. Here's the long-term math that kills Group 2. The stock market has historically returned about 10% a year. A high-yield savings account right now pays about 5%. That sounds like half the return for zero risk. Not a bad deal, right? But run the numbers. $100,000 in the market at 10% for just 5 years grows to about $161,000. That same $100,000 in a savings account at 5% becomes about $127,500, a roughly $33,500 gap. And our friend compounding widens the gap every year. After 10 years, you're down about $96,500, and after 20 years, the gap is just over $407,000. And that's before you account for the fact that inflation is eating about 3% of that 5% savings return. How safe does an annual 2% real return actually feel? Group 2's account balance goes up every month. They never see a red number, but they fall behind by hundreds of thousands of dollars, invisibly, because they optimized for comfort instead of growth. So here's what's actually happening. Group 1 and Group 2 look like opposites. One can't stop trading, the other won't start. But they're both being driven by the same thing. Psychologists call it action bias, the compulsion to do something when uncertainty hits, even when doing nothing is the better option. Think about a goalkeeper in a penalty kick. Studies have shown that goalkeepers dive left or right about 94% of the time, but the data shows they'd save more goals by staying in the center. They know this, coaches know this, but it feels wrong not to move when a ball is flying at you. Doing nothing looks passive. So they dive and miss saves they would have made by standing still. Group 1 is the goalkeeper diving left and right on every market dip. Group 2 is the goalkeeper who walked off the field entirely because they didn't want to look foolish. Neither one is standing in the center, and standing in the center, doing the boring, uncomfortable nothing, is where the saves happen. So what does standing in the center actually look like? It's not sexy, it won't feel smart, nobody will congratulate you for it. But 30 years of data points to the same conclusion every single time. First, separate your decision-making from your account balance. The moment you start reacting to what your portfolio did today, this week, or this month, you become Group 1. Delete the app from your phone if you have to. Check your investments quarterly at most. The data is very clear. The more frequently investors check their portfolios, the worse they perform. Not because the information is bad, because the information triggers action, and action is almost always the wrong move. Second, understand the difference between a plan and a reaction. A plan is a set of rules you wrote when the market was calm. I invest X dollars every month regardless of conditions, I rebalance once a year, I don't sell unless my life circumstances change. A reaction is anything you do because of a headline, a gut feeling, or a conversation with your brother-in-law. Plans build wealth, reactions destroy it. 30 years of data say so. Third, accept that discomfort is the price of admission. There is no version of long-term investing that feels good all the time. The market will drop 20% or more at some point during your investing life. Probably multiple times. It's done it more than 5 times over the last 30 years. When it does, your chest will tighten, your brain will scream. And the right move, almost certainly, will be to do absolutely nothing. That feeling of doing nothing while everything seems to be falling apart? That's not recklessness. That's the cost of being on the right side of the math. Group 1 lost money because they kept trying to be clever. Group 2 lost money because they kept trying to be safe. The Magellan Fund investors had the greatest track record in history handed to them, and they traded it away. The cash sitters had time on their side, and they gave it up for comfort. Both groups were smart. Both were well-intentioned. And both were wrong. Because the market doesn't reward intelligence. It doesn't reward caution. It rewards patience. The kind of patience that looks stupid in the moment and only makes sense years later. And the real test isn't today. It's the next time the market drops 20% and every headline tells you to get out. That's the moment when people become Group 1 or Group 2. The question is which one you'll be when it happens. And here's something that affects us all. The new Fed chair has a plan to deal with our out-of-control government debt, and you're not going to like it. Click the video on your screen right now to see exactly what's coming next. And don't forget to subscribe for more insightful content like this. Remember, this isn't personal financial advice. It's education so you can build your own plan. To help you, I've got links to Seeking Alpha discounts, my free Wealth Builders Blueprint, and Zach's Confidential with dual money-back guarantees down in the description. Check them out. See you in the next video.